NVIDIA alone is worth more than Germany's entire GDP. One company, one economy. If that doesn't terrify you, it should. Right now, 10 companies make up over 40% of the S&P 500. Your retirement account is a house of cards built on 10 names. Everyone believes the danger is behind us, that inflation is defeated, that the Fed has everything under control. But every great collapse in history began exactly like this, when optimism felt unbreakable. Late 2025, markets euphoric, debt at levels we've never seen. Underneath, cracks are widening, and when they give way, it won't be a dip, it'll be an avalanche. I'm going to show you the 3 indicators that have never been wrong. And by the end of this video, you'll see exactly why 2026 could be the year everything breaks. The S&P 500 hums near record highs. AI stocks dominate every headline. Retail traders are back, loading up on leverage. News anchors repeat the same lullaby. Soft landing achieved. This is textbook complacency. Ask yourself, are you holding leverage right now? Did you buy more in the last dip because it always bounces back? You're not alone. Millions are doing exactly that. And that's precisely when markets turn vicious. In 2000, investors said, tech will change the world. In 2008, housing never goes down. In 2025, the Fed won't let it crash. History doesn't repeat, but human nature does. Every bull market ends not with fear, but with overconfidence. We are not witnessing panic yet. We are witnessing denial at its absolute peak. The story began in 2020. Faced with total collapse, governments printed without limit. Zero rates, trillions in stimulus checks, global money printing on steroids. The world's money supply exploded by over 30%. And for a while, it worked. Demand surged, stocks soared, optimism returned. But that surge wasn't growth. It was an illusion, a mirage of liquidity shimmering across an empty desert. Now, the mirage is fading. Corporations that refinance debt at 2% now face 7%. Governments run deficits that would once be called wartime spending. Here's what that means for you. Your mortgage payment doubled. Your grocery bill is up 40%. Your salary? Flat. We are in an era of fiscal dominance, where debt dictates policy, not the other way around. The post-pandemic boom wasn't prosperity. It was borrowed time. And the bill is coming due. 1929 had margin debt. 2000 had profitless tech. 2008 had subprime housing. 2025 has everything. Stocks, bonds, real estate, crypto, private credit, all inflated by 15 years of free money. But here's the trap. This time, there's no room to cut rates. The safety net is gone. Inflation is still sticky. Debt is sky high. The Fed is trapped. Each decision now carries collateral damage. Cut rates. Inflation roars back. Keep them high. The economy cracks. It's a game of Jenga where every move makes the tower more unstable. October 1929. Taxi drivers brag about stock tips. Margin loans at record highs. The radio proclaims a new era of prosperity. Sound familiar? Then the whisper becomes a scream. Phone lines jam. Orders fail to execute. $30 billion in wealth evaporates in 1 week. Optimism turned to dust overnight. The world learned that confidence is not collateral. The ones who saw it coming were called paranoid. The ones who stayed in were called victims. Which one are you preparing to be? Why do we keep falling for this? Because markets aren't math. They're emotion-wearing numbers. The cycle never changes. 1637. Tulip Mania. Bulbs cost more than houses. 1929. The Roaring Twenties. Stocks only go up. 2000.com. Revenue doesn't matter if you have eyeballs. 2025. AI euphoria. Profitability optional if you have GPU access. Different centuries, same human brain. Here's the pattern. Investors tell themselves, this time is different. They watch the skeptics miss out. They go all in near the top. Then gravity returns. The ones who remember this simple truth always look paranoid in the boom and brilliant in the bust. On the surface, the numbers still glow. GDP positive, unemployment low, headlines bullish. But underneath, the machine is breaking. 80% of S&P stocks are underperforming the index. That's not a healthy market. That's concentration risk disguised as strength. Consumer sentiment is below 2008 lows. Job openings are collapsing. Corporate earnings outside the Magnificent Seven are shrinking. Your 401k might say plus 15% this year. But it's riding on 7 stocks. When they sneeze, your retirement catches pneumonia. That's not diversification. That's fragility with a bow on it. The 1970s taught a brutal lesson. You can't print your way out of scarcity. Oil prices quadrupled. Inflation hit double digits. Governments eased monetary policy and made it worse. By 1980, interest rates hit 18%. An entire generation learned what stagflation meant. Growth dead, prices soaring, no escape. Today we're flirting with the same recipe. Energy strained from AI, data centers sucking power, sticky inflation that won't die, central banks too scared to truly tighten. While the S&P makes headlines, real people are drowning quietly. Groceries up 40%, rents doubled, first-time homebuyers priced out forever, graduates working gigs, not careers. The charts say boom, your wallet says bust. When this bubble pops, it won't just erase numbers on a screen. It'll erase dreams, savings, retirements. This isn't financial advice. It's perspective from pattern recognition. Rule number 1. Respect liquidity. If you can't sell it in 24 hours, you don't own it. It owns you. Rule number 2. Kill your leverage. Debt turns corrections into personal collapses. 2% margin looks smart until it costs you everything. Rule number 3. Diversify across realities. Hold assets that survive both inflation and deflation. Cash-flowing real assets and selective commodities. Not sexy. But they survive when everything else burns. Rule number 4. Stay psychologically solvent. Fear and greed move faster than the Fed. The investor who panics last loses most. Rule number 5. Study history. It doesn't repeat, but it rhymes loud enough to hear if you're listening. Preparation beats prediction every single time. Here's the truth they don't teach you. Wealth never disappears in a crash. It moves. From the unprepared to the prepared. From those who believed the illusion to those who saw through it. 1929. Fortunes transferred from margin traders to cash holders. 2008. From homeowners to distressed asset buyers. 2025 to 2026. From euphoric investors to the patient few. Crashes don't erase money. They redistribute it. The question isn't if wealth will move. It's whether it moves toward you or away from you. Position yourself now. Maybe this time really is different. Soft landings are possible. They're just rare, because humans don't stay cautious long enough. All it takes is one shock, one policy mistake, one geopolitical flashpoint, and gravity returns. Preparing isn't pessimism, it's prudence. Hope is not a hedge. When historians look back on 2025, they'll see the signs were everywhere. The yield curve screaming, the debt ratios exploding, the concentration risk blinding. We just chose not to see them. Calm seas never mean safe waters. The crash might not come tomorrow. It might not even come in 2026. But the conditions are set. The fuse is lit. And when it ignites, the unprepared will be swept away. This is Macro Sentinel. Your eyes on the next financial storm. If this video made you think twice about your portfolio, subscribe, stay informed, and most importantly, stay solvent. The storm is coming. Will you be ready?